So the first question I've got for you is, can we believe the market bounce this morning?
So the market is moving, and it's path dependent on the developments of the virus. What you heard overnight was some modest improvement within the trends within the pandemic in Europe as well as in the tri-state area. So that emboldened risk-taking in the short run.
All right, so we're watching then many experts and portfolio managers tie their investment decisions to the trajectory, the curves, if you will, of various measures in the coronavirus outbreak, whether it's cases per day, the total number of deaths, the total number of new cases and everything. What exactly are you watching for right now that will make you more constructive on markets?
So there are three things. One, you have to obviously look at the high-frequency data, talking about the mobility of Americans and as well across the globe. Will there be an improvement within business activity, as well as, like we just mentioned, the outbreak trends? Also, you look at U.S. monetary policy. As that comes online, that can embolden and at least decelerate the volatility within the credit markets. Fiscal stimulus here in the United States. And also keep a careful eye on the Europeans. If they move towards more of a solidarity when it comes towards economic activity and fiscal stimulus, that could at least improve the stability within the financial system.
All right, so given that backdrop that you just mentioned and what you're watching, what exactly are you doing in terms of figuring out opportunities? Where exactly should money be deployed? Is this still a situation where you're raising cash on rallies? What exactly goes on the shopping list, given the fact that you are watching all of those things?
So several weeks ago, as this credit dislocation started to really accelerate, my partner Kevin Karan and I started to aggressively lean into individual equity risk as we started to see long-term forecasted returns for value stocks gap higher. And currently right now, our estimate is a long-term forecasted return of 9% for the value index over the next 5, 7, and 10 years. So we are looking at consumer staples, for example, consumer discretionary, as well as some select industrials, as real steady Eddie companies that could actually be kept and held in one's portfolio for 2 to 3 years.
All right, so you mentioned those industry groups. What exactly are you looking for within those value-oriented type names? What factors stand out to you as the reason why you would choose one stock over another?
So, Dominic, what we're looking at are individual companies that don't have a lot of debt on their balance sheet, that are well diversified and quite highly predictable, with tremendous earnings potential 3 to 5 years out. So look at companies like, and we've been purchasing Visa, for example, Nike, Walmart, Hormel, Pepsi, and Procter & Gamble. All of those companies that I'm listing here have very little debt. You don't have to be concerned about liquidity issues if this continues over the course of the next 3 to 6 months on the credit side. These are companies that will be paying a very steady dividend and with high predictability for their earnings several years out.